We're going to be talking about how to handle your first investor call. We're going to be talking about best way to handle prospective investor calls, or the most common questions prospective investors will ask during the call, what outline you should use during the call, key questions to understand investors' motivations, and then also getting in the right mindset for these calls. And in the past, when I did do this, I was thinking about this last night. These calls were heavily focused on the discovery call. Oh, I should probably introduce myself too. Myself, I'm one of the investor relations associates here at passiveinvesting.com. Been here for over a little over 2 years now, and I've probably had like 600, 700, almost actually not even 600, close to 700 investor calls, and it has ranged from a number of different types of investors, whether they're seasoned investor, whether they're new investors just learning about the space. But regardless of their experience, there is still a fundamental structure and also outline that you should take when you're first hopping on the call with them. And there's also two different types of calls as well. So there's the discovery call where you're just touching base. They somehow heard about you. They kind of know about multifamily. And now you're looking to just learn about them and what they're trying to accomplish. But then there's the other first call, which is the deal specific call. So when you are actually in the raise, those calls are a little bit different, but there is still a similar mindset and also structure to it as well. And so that'll be a little golden nugget at the end after we go through the discovery call, because the discovery call is extremely important. That's your first impression of when they are being introduced to you, and what you're trying to accomplish, and also what you're trying to learn from them. Oops. All right, I can do this. For the call, though, there should be a lot of homework leading up to this point when you get to the call. So like just for preface, I didn't actually start hopping on calls here at passiveinvesting.com until like 3 months later. A lot of it was shadowing, a lot of it was practicing, a lot of it was just role playing, and just getting used to feeling comfortable and articulating a lot of these terms, but then also more importantly, articulating the story of the managing partners, the background, the foundational principles, the values that we have, because those make a big difference, especially since apartment syndication is a people business. It's a relationship business. This isn't transactional where they purchase something and then that is it. You could essentially be locked in with somebody as a limited partner for 5 years, 7 years, 10 years, however long your holding period is. And so at the end of the day, people need to feel comfortable and trust you and know who they're working with. So you want to make sure that you have your partner's story in check before you start at least hopping on a call, and then also track record too. And if you're brand new, I highly recommend trying to find a partner who has experience in this. And reason being is just because the frame looks a lot different when you have that experience. I know that's, uh, I guess I know that's a easy, of course, that's like easier said than done. And then also it's almost like obvious. It's like, duh, but the frame really does matter when it comes to something like this. Because like, for example, for me, if I just started coming on here and saying, hey, this is how you do prospective investor calls, and I've only done calls but never closed a deal, and I don't have the experience of the partners behind me, everything that I say is kind of mute, right? Because the frame just looks a little bit different. So try and find those experienced partners if you're brand new. That's the easiest or fastest way to expedite your investor call journey. Make sure you have case studies ready, and these case studies, and I'll dive into this too a little bit later into the presentation, but then also be ready to articulate fundamental terms. And we're going to make sure that it's simple, because once you start hopping on these calls, you don't necessarily need to articulate every single term that's out there, because you don't necessarily want to try and prove that you know everything. You want to be able to meet wherever the investor's level is at. And I'll dive into that. So I already touched on this. Understand you're building a relationship. You're not selling them. Also understand that you have the opportunity as well. You're vetting them as much as they're vetting you. So I know there's a sense of confidence that somebody needs to walk into the call I mean, yes, we do, let's say, need to partner up and we need LPs in order for us to do the business. But also, on the other hand, we also have the deal flow, we have the expertise, and we have the experience to be able to invite them to invest in an asset like this. And so, understand it goes two ways. I know starting out, it could be a little tough because you're now trying to get them because you know that you need to partner up with them, but you can't come off as desperate. And at the end of the day, they're really just trying to figure out if you're reliable, competent, and a trustworthy person. You want to make sure that you're keeping it simple and getting out of the weeds. People care more about the who. I already talked about that. I'm about to go into the structure, keep it high level. People love stories. Keep it simple, stupid. And then also, last thing, before we dive into the actual structure of this discovery call, your first call is probably going to suck. Now, I don't mean that to say that you should go into there without confidence and thinking like, I don't know how this is going to go. Like, of course, like you do your homework and you practice and practice and practice. But as much as you practice, there's no replacement other than getting reps. My first few calls were uncomfortable, and then you start getting better, and then it starts getting a little bit uncomfortable. But over time, as you're starting to have more calls, you're going to start to uh, find your rhythm, find how you like to articulate things, hear what makes sense. I remember when I was first starting out, I would talk about certain terms, and then there would be certain ways that I would articulate terms, and they would throw them off, and they just wouldn't understand. And so I had to go back and try again with another call and another call. And I never would have gotten that if I just didn't get past those calls. So remember, reps are important, even though this is your first call. You want to make sure that it's not the first call that's going to switch everything. It's after a number of reps that you're going to get better. And then, like I said, adapt to your audience, different experiences and personalities. You're going to have people that are completely new to syndications, seasoned investors, active operators, type A personalities, the shy investor that just doesn't want to say anything. And you just feel like you're talking to a wall and it's like an interview in a way. But you're going to have to figure out how to cater and meet them at their level. Now, with this discovery call, you want to establish your frame, go into the discovery phase and have them kick off the call, go through an overview and essentially the hits of who you are, what you do, and then what they can expect from you. And then you go into frequently asked questions, establish expectations moving forward from the relationship, and then nurturing the relationship. So establishing a frame. Number one, so this is the overarching theme of the entire call, is make sure that you maintain control of the call. And this is what I mean by establishing a frame. Making sure that you have control of the call doesn't necessarily mean talking over them, asking all these. I mean, you're going to be asking questions, but it's not to be, you're not going in there acting pretentious, like you know it all either. You're just controlling the call in a way where where you're going to be guiding them throughout the conversation. And guiding them throughout the conversation and still maintaining that authority is a skill in itself. And it is still done through asking questions, then also how you structure the conversation. So when we first hop on a call, I always call them. I don't let them call me. I take control of the conversation right from the start, and you're showing that you're punctual and prompt. And so when I call them, I say, hi, this is Taylor with passiveinvesting.com. Is now still an okay time to chat? This call should only be for 15 minutes. And what that does is, I mean, one, it lets you know that you're punctual and prompt. And then also, if you tell them that this call is only for 15 minutes, they're also going to understand that they also have a way out, and there's a finite timeline to this conversation. And they also know that you're busy as well, hopping on other calls. So let's get through what we need to get through, because they don't want to waste your time and you don't want to waste their time. When we go into the discovery phase, I always ask them to kick off our call. So I say something along the lines of like, since this is our first time connecting, I'd actually love if you can kick off our call to let me know a little bit more about yourself, what you do work-wise, real estate investing experience, and then also investment goals. I always want to make sure that they're kicking off their call, because when you start a call, you don't want to be on your heels. And so actually I had an example yesterday where somebody hopped on a call with me and immediately they were like, "Oh, I just want to know about what you do and the type of assets that your firm is going after." I was like, immediately, right after the jump, after I introduced myself. What I did was I actually I didn't evade the question, but I pivoted and said, "Yeah, I'd love to go into that, but before we do go into that, I'd love to know a little bit more about you since this is our first time connecting. So, can you share with me a little bit more about yourself, what you do work-wise, real estate investing experience, and then investment goals?" Reason why I want to do that is I don't want to get caught on my heels. If I answered his question, now he feels that, or they feel that they can ask whatever questions, then you don't really know where the conversation is going to go because you don't really know what questions they're going to ask. It could go anywhere, to be quite honest. And so you still need to figure out what you need to get out from from this conversation. And right now, you're painting their investor profile, you're painting their investor avatar, you're learning about their investor criteria with this discovery phase. And that is by asking questions. So they go off, they talk about what they do work wise, they talk about their investing experience. Maybe they're operators, maybe they've been an LP, maybe they're just learned about this through Dan and Danny's book. Shameless plug. Um, so the next question that I ask, because typically investment goals, when they're talking about, oh, I just want to get the highest ROI on my capital, I always ask specifically, are you looking for more supplemental income and cash flow, or are you looking for more back end equity? Maybe a nice blend of both. This question, while it may seem simple, it does give me more insights on how frequent these investors want distributions. Are they retired and are relying on monthly distributions? Are they okay with a slower cadence of distributions and okay with quarterly distributions, or okay with distributions starting year 2 or year 3? So you really start to get an idea of what they're looking for and what they care about. Sometimes they've never really thought about it and they're like, "Oh, okay, well, I probably should know that question." They just know that multifamily is a recession resistant asset. And then this one brings into another light, and now you're educating them and they're seeing you as a trusted individual. And then it gets better because they're going to start to trust you even more because now you're asking about different asset classes that are they're diversified across. They could be multifamily, it could be storage, it could be car washes, they could be open. They could just have some background in residential and they're just learning about it. But this will tell you what they're into. That I mean, if they're into startups, then you know that they're a little bit riskier. If they're into storage and multifamily, then that they want to be more risk averse. So, and that's really what we're trying to understand is their risk tolerance as well. What do they feel comfortable, and can we provide an opportunity that actually aligns with what they're looking for? Oops. All right. Oops. Don't want to get too ahead of myself. So then I go into like after I ask these questions, I actually ask, so how did you hear about us and how familiar are you with us and our group? Now, when I ask this, I just want to get an idea on if I need to inform them on who we are. Sometimes I don't know if I'm talking to another operator that's already familiar with us. And if that's the case, I don't want to pitch who we are and what we do to somebody that's already in the business. So, like, for example, I actually I knew of somebody that he was pitching to a person that was very well known in multifamily. He even wrote a book about multifamily. I knew who he was. This other person didn't necessarily know who he was. And so he was telling this person all about the benefits of multifamily. And at that point, it's like, okay, you don't really know who you're talking to. So you just want to really get an idea of who you're talking to before you actually start opening your mouth. But let's just assume that they don't necessarily know who you're talking about. Then you go into what I call the hits. And now you're going to be talking about who you are, the markets you're invested in, and then also what they can expect from you. Now, I mentioned this in the beginning of this conversation in presentation that people invest in people. There's a large emphasis on the who. And so when I talk about what we do, there is, I mean, I would say 50, well, Yeah, 50, yeah, sure. 50% of it is really just on the background of how we got started and then now what they can expect moving forward. So I go over the highlight partners experience, markets, track record, current deal opportunities, what we have now, and then also what they can expect from us moving forward. Oh, you know what? I thought I had another. So I'll say what I say and our hits. And our hits is a little bit it's a little more long-winded, but the reason why I mention all of these is because these are typical. There's a frequently asked questions, and then these are like the uh most frequent, like frequently asked questions. They're the ones that everyone's just trying to know, and if they understand this up front, then it can open up the conversation to other aspects that they're looking for, which goes into the other frequently asked questions. So this is like the preface of the frequently asked questions, then to the act to this is the actual frequently asked questions, and then there's the additional frequently asked questions that sometimes comes up. So here we go. So, passiveinvesting.com, we are a private equity real estate investment firm focused on 5 different asset classes. Institutional quality multifamily. These are your suburban class A or B plus type assets, typically 2016 or newer. Even at times, we've bought them directly from the developer. We don't do any ground up development as of yet. We're also focused on storage facilities, express car washes. We have a preferred equity fund called the Alliance Fund. And then we also have our debt fund, which is our more liquid option compared to our other investment opportunities. Our 2 managing partners are Dan Handford and Danny Randazzo. Some background behind those two. Dan Handford, the first managing partner, he actually got to start as a chiropractor, had his own practice, wanted to scale up, ended up scaling to 4 practices debt-free, ran into the issue of just writing very large tax checks at the government. And so he wanted to find a more tax advantage way of building wealth. Got to start as a passive investor first in apartment buildings. Even though he's transitioned full-time into our business to oversee all of our strategic objectives for the firm, he's still a passive investor in 90 different deals with 17 different operators. And so for us, he takes his skills in scaling and operating these 7 and 8 figure businesses while also utilizing his experience as a passive investor to improve our investor experience here at the firm. The second managing partner, Danny Randazzo, formerly a financial consultant for Deloitte, was traveling the world advising companies on their profits and operations, came to a point where his family was just tired of him being away from home so much. So he started investing in multifamily in 2013, was able to quit his job in 2018. Now he's full-time in our business, overseeing all of our financial analysis and underwriting across all of our assets. Alongside those two, you have a full-time team of 50 employees that covers all areas of the business, from acquisitions to investor relations to investor services. And we look to provide opportunities primarily in the Sunbelt Southeast, with the market somewhat on the other side of the nation, dependent on the asset class. These markets include North Carolina, South Carolina, Florida, Georgia, Texas, Tennessee, Alabama, and Colorado. Since we got our start as a firm in 2018, and that is just the year that we came together, they were either operators beforehand or working for other firms beforehand. But since 2018, we've gone full cycle on 8 deals. All of those deals were underwritten for 5 years, but we've exited those deals on average 3 years or less, an average return of 26.1% IRR. Now, moving forward, we currently have 2 opportunities available. So there's the Alliance Fund and Debt Fund. And moving forward, we anticipate anywhere between 8 to 12 deals for the year, but I will say deal flow is a little bit slower, especially at the pace of last year and then this year. So we are anticipating 4 to 6 opportunities, and that could be a mix of the asset classes. Bowing for that. And I'm just imagining all of y'all clapping here this morning. So, but as you can see, there's an emphasis on the who. So imagine if I just switched all of this around. So if I started with our deal pipeline, and then I went to deal opportunities, and then I went into track record, and then I went to markets, and then I went to the partners experience. So this whole framework, I probably should have mentioned this in the beginning of the presentation, but this whole framework is from Pitch Anything by Oren Clough. It's how the brain processes information. The reason why I start with a who is because when somebody is first talking with you, they are trying to see if they can trust you. And if they don't trust you, everything after that is not going to actually hit the parts of the brain that you want it to. So like if I started out with the track record and say, hey, our firm is 26.1% IRR, and we currently do 8 to 12 deals per year. Dan Handford is our managing partner. It doesn't have as strong of a frame because once I mentioned that 26.1, which is a pretty high IRR, now they're going to be thinking like, okay, well, how do I trust that he actually got there? But if I started with the managing partner's experience and saying, hey, they've been doing this for a long time and they're also an LP in several different deals, it makes the conversation and the information afterwards a lot more digestible because now they have context to be able to relate back to the information and to the people that are running the business. So when it comes to questions and FAQs, the worst thing to do is to dig yourself in a hole and go down the rabbit hole. You want to make sure you keep it as high level as possible. If you cannot explain a term in, let's say, 1 to 2 sentences, okay, maybe 3 sentences if you want to get a little crazy, um, then uh, then well, you should practice and get to that point, but then that shouldn't be the entirety of the conversation because what people don't necessarily care if you know what I mean. They do, of course, care like if you know what exit cap rate that you guys are projecting, if you know what a preferred return is and what an internal rate of return is, but never have I thought about, never have I trusted somebody because they over-explained what a preferred return is and they dove into it and dug their own hole. So like you want to be able to simplify it and meet them at whatever level that they're at. Actually, I was on a call yesterday and there was, there was a lot of questions that are coming out. This person was new, and I definitely could have gone more into it and described, I guess, the theory and all of these terms and why this is that. But that doesn't necessarily move the conversation that much. I think because they're not going to like if they don't understand it on the call, likelihood of them understanding it within like the 30 minutes that you have with them, it could be pretty unlikely, but you also want to give them more information and it also justifies another follow-up conversation. So keep written articles handy. Yeah, so these are the frequently asked questions, the second frequently asked questions. So they're going to ask what your track record is. Why should I invest with you over other operators? Has there been a time where you've not performed or failed to meet projections? This one is extremely important as well. So a common question that's been coming up is this: have you ever done a capital call? Considering the state of multifamily, and what we found is transparency, of course, is key. But then even explaining it more so in story format, though. And it's not like a story where you're embellishing all of these details and be like, oh, we were so stressed out, and then we wanted to increase rents by 300 and we couldn't increase rents by 300. And we are like, oh my God, not like that type of story, but stories where they like simplified stories, where they can relate to the actual situation. So for this one, this is two of the examples and also how I frame the conversation. If somebody does ask me is, no, we've never done a capital call and we've never not failed to meet our projections, but I'm not going to sit here and say we are perfect operators either. And because we all go through our own set of obstacles and challenges as well. And so I'll speak to one instance that happened when we were early on in our acquisitions, and then also what's happening now considering the economic environment. So back then we were going after more B minus C plus assets, and we were wanting to increase rents by $300, and we had a renovation budget of about $14,000 per unit. So what we did was we renovated 2 of those units and then brought those out to market at the $300 rent increase. When we brought those out to market, we heard nothing. We brought it down to 270. We still heard nothing. We brought it down all the way to 200. We still heard nothing. And then we finally found that sweet spot of $170 rent increase. So just from that experience, we had to go back to the drawing board, and we were able to cut our renovation budget down from $14,000 to $7,000 and reprioritize what we were going to be working on. And that was a big learning lesson for us, just to make sure that we're more knowledgeable of the market and also more conservative in our underwriting moving forward. We were still able to meet our projections, actually exceed our projections, but that was just a learning lesson for us. Now to today, considering a lot of multifamily operators bought with a floating rate and then had a rate cap. But even if that rate cap was there, because interest rates rose so rapidly, the debt service is still high, and it was hard for a lot of these operators to react. So we do have some assets that we had to move from monthly distributions to quarterly distributions, and then even move from quarterly distributions to paused distributions. But we did this because we wanted to make sure that we maintain the viability of the business. Now, and also protect investor capital. Now, we're not concerned for these deals in the long run, considering these are all 90+% occupied, but we do need to still withhold distributions for some of those assets that are struggling to make sure that we can get through this economic environment. I'll bow again. Hopefully that was a good enough answer for y'all. But I use that example, though, because you need to walk them through your thought process and understanding. Yeah, so that's like a story format. Another question that frequently comes up is tax benefits. Understand if you guys are doing cost seg studies and if there's bonus depreciation. What I like to do is I also send sample K1s with, of course, the names redacted and the social security number redacted, so they can't see that. So make sure you do that if you are sharing sample K1s of what people can expect, so they can go to their CPA and be like, oh, does this help my situation? And then how I already responded to the interest rates question. Oh, I guess I didn't, but I mean, acquisitions is just a lot slower. There's a big discrepancy between buyers and sellers' expectations, and cash flows are a lot lower now. And I mean, to be quite honest, we haven't done a multifamily deal in over a year and a half, just because the margins on these deals are so thin. Also, something that I say in acquisitions, or when it comes to like our deal pipeline, make sure you know your fees. Also, how those fees are taken out of. So if it is a percentage, are they taken out of the gross transaction amount? Are they taken of the equity needed to raise? Are they performance-based fees? Understand the business plan and also the exit strategy, also the average hold period across all of your deals, whether it's 5 years, 7 years. But these are like 90% of the questions. If there's after all of these calls, there is rarely a time where other questions outside of this come up. And even if questions outside of this come up, it is okay to say, let me get back to you on that. I don't know. And I'll follow up. Well, okay, maybe you don't say, I don't know. Don't say, I don't know. Just say something along the lines of, I'm going to reach back out to the team and I don't know, give some more information on that question. But that is a great question. It's okay to say that. You don't need to know absolutely everything, but if you don't know something, don't lie about it and don't act like you know about it. Just get them the right answer and follow up accordingly. Now, after the call, establish expectations, tell them what they can expect from you, and then most importantly, just do it. Follow up with an email with resources, open opportunities, recently closed opportunities, just so they can get some more familiarity with us as a group. And then give them some information if you have a portal, how they can access the portal, how are they going to be notified on new opportunities, and then also text them your contact card as well. I like this touch because it can put a face to the name, and then they can also call or text you in case any questions come up, and it's not like they have to schedule on a link. So it makes it a lot more approachable. And I mean, it's yeah, like if you notice that too, like Dan and Danny, if you ever attended one of our webinars, they're always giving out their phone number and then email. So communication is absolutely key. And this is actually one of Dan's biggest gripes with investing with other operators is communication. And he is really ingrained in us that we want to make sure that we are transparent and as accessible as possible. So text him your contact card, let him know. I say something along the lines of, now that we've had this conversation, you're considered part of our passive investor club. So you'll be notified on any new opportunities, master classes we're hosting, and then also any events that we're having in your area. And then I just send them the email, send them the text as a follow-up, and then that is the end of your first call. You did it. Congratulations. And then now you're going to have more calls and get better and better and better. And then after that, so next week, we're going to be talking about the nurturing phase of it. And we're going to be talking about the 3 key content types that I've used in order to further the conversation moving forward. But that'll be next week. So I'll join you next week. I didn't forget about the golden nugget though. So we talked about the first call as a discovery call, but let's say that you actually have a deal that you're looking to raise for. It is a little bit different than webinar format, but the same fundamental principles apply when you are speaking about a deal that you're inviting other LPs to invest in. You don't want to start with the numbers and analysis. You want to work your way down into the numbers and the analysis. You want to be able to create the frame of what makes sense and why you like the deal. And then the numbers will start to back it to start to work its way there, right? So how I typically start talking about the specifics of the deal. I mean, I talk about the location of the deal first, the market and the demographics, the why the seller is looking to sell. So if you know this information, this could paint a picture for your investors of why we're really getting this at a strong basis. So like, for example, we were looking at a deal where there was, we're essentially getting it at the same price that they bought it in 2021 because their preferred equity providers is forcing them to sell. And so they're trying to move on from the project. And that's what brought us to be able to come in at a really good basis. If you know that information, great to share. Yeah, great to share. And then you can go into the business plan of what you're looking to do and try and stay away how long the stabilization period is going to be, and then your holding period. Then you can start going into the financing terms, whether it's fixed rate, floating rate, start going into the cash flows, net LP return. And I feel like a lot of the questions then comes into like the underwriting. Now, when questions come about the underwriting, just answer it. Go simple and straight to the point. You don't necessarily need to be like these are very straightforward questions, and if you can answer these straightforward questions and give like specific ranges or just give them simple answers and keep the conversation snappy, and you don't have to like over explain things, then like you'll be okay, right? Like you don't want to try and prove your knowledge and try and prove your underwriting, because the fact that you're presenting it to them already is already proven enough. So like I was thinking about an example yesterday before coming on to here. So like let's see, what's a good example here? I don't really like this example. Well, we'll see. I don't know. Let me know your thoughts. I'm still learning to grow. So rent growth. I was if somebody were to talk to me and say, oh, well, this market in San Jose, it's rent growth has been experiencing 25%, and we've conservatively underwritten 6% rent growth, and that is a lot lower than what market rent growth is. Like if you just said it's 6%, and then if they ask the follow-up question then, and be like, oh, what's the what's the market rent growth, then it gives you like another key and another way to say like, oh, I already know that answer. It's 20%. Why are we still asking these questions and continuing to move forward in the conversation? So I don't know if that was a good example. Let me know though. I'll think of other examples if and possibly put in the next presentation. But yeah, paint the story first, work your way down, get into the numbers. Don't start with the numbers and the analysis, because then they're just going to try and they don't know if they trust your numbers and analysis. Awesome. I hope that was helpful. I'm going to stop sharing. And also this presentation is going to be sent out with the webinar replay. I believe it's going to be tomorrow. So you guys can have full access to that as well.